Hello, everyone. I am so excited to be here for our first guest expert interview on the Family Entrepreneur Life Live series. And today I have a very special friend, Christi Bender, here with us to talk about an important topic. Christi is a CPA and a CTM, which I did not know this was a thing, but it's a certified tax master. She is not your normal tax accountant or bean counter. She's adventurous, curious, passionate and bold, and an expert in individual and business taxes. So I am so excited to have her here today, and we're going to be talking about how to save thousands of dollars by not making common bookkeeping or recording mistakes. So Christi, hello. Thank you for joining us.
Hi, Ariana.
Why don't you go ahead and give everyone, if I missed any of the gaps in the intro or your bio, or just, tell us a little about you and why you chose to do this.
Okay, so I started out as a CPA. I've had lots of different CPA lives in corporate, in public, and a little less than a decade ago, I landed in the tax world, largely because I live for vacations, and it means that I have time to take them. You and I have had chats about my vacation schedule before.
Lots and lots of vacations.
And it's funny because in some ways, this idea of saving money on tax dollars, I equate directly to, oh, good, that's another free trip. So if you save a couple $100, that might be a really fancy night out. You save $1,000, that might be a day trip kind of weekend. You save $5,000, we're talking a real vacation. So the faster I can save tax dollars and basically get the government to pay for vacation, the more fun it is. But I've really realized in just the last year, I guess, as I started really working on, what's my why, that in our Western society, money plays such a huge part in our personal identities and how fully we embrace our lives and what we believe is possible. So to the extent that I feel like I can encourage people to be really responsible with their money, it transitions over and they become really responsible about their lives. When you're responsible about your money, you tend to have more. When you have more, you now have more ability to do the things you really want to do with your life, and you kind of leave the whole victim thing aside. So the two dovetail, it makes the whole bean counting thing a lot more interesting if there's a bigger why and a vacation at the end of it. That being said, for me, the big thing is vacation. But for a lot of people, it's saving enough money to pay for their kids' college so they don't come out with debt. For other people, it's being able to support their parents as they're aging. Or, they have a special person in their life that may have a disability or a special need, and they want to be able to contribute to that more fully. So everybody has a different why in that vein. But to the extent that we can do what we're supposed to do anyway, better, and we can keep money away from the government to fund the things that matter to us, I just think that that's the biggest carrot you can really get, is why do you want this money, not just I don't want to pay it to the government.
I think that's powerful. Yeah, having the bigger why behind it all.
Yeah. So we were, everybody voted on the Facebook page, and we decided that we want to talk about how can we save thousands of dollars in taxes. And the first thing would be you have to have a bookkeeping system. I mean, we're just going to start with the nuts and bolts. You need to have one. Preferably, I like QuickBooks because it's actually a debit credit system. It gives you a full set of financial statements. You can run comparisons. You can isolate periods of time. You can dig into it more easily to get the information you need as a business owner. That whole business owner component of this is a separate little chat. But first, you have to have a bookkeeping system. So that would be my first thing, is get that so that you can see what's going on. If that doesn't work for you for whatever reason, Excel is probably the next most used system because it will at least do the math right. And you can move columns around and graph some things and stuff like that, but it cannot give you financial statements in the traditional sense. So if we take it, we're just going to assume that somebody's got a basic functioning system of some kind. We're going to start with that assumption. So then the first way that you really save tax dollars is you stop. I mean, eliminate completely. No more, not allowed. Won't even think of it. Commingling your funds.
Yes.
Yeah. This idea that you have a business account here, and I call it the kitchen account over here. And the two do not talk. Business account does not pay for haircuts. Kitchen account does not pay for, professional licensing fees. They are separate. And one of the reasons that this saves you lots of money in tax dollars is if you don't have a closed system for your business finances, you can't ever prove it. You can't reconcile your bank account, truly. You can't reconcile your credit card statement. You can't know that you've got everything captured in that one place. So if everything's not captured, that means that it's lost. If it's lost, it's not showing up on a tax return. Mm. So one of the couple areas that people really tend to be bad about their commingling are, oddly enough, and I don't understand why they do this. I think it has to do with the amount of money people leave in their business account is when they go invest in new technology or an advanced training program that's, 4 digits, maybe even 5 digits, they pay for it out of the personal funds because they've sucked all their money out of their business and, well, that's where it is. So they don't put it back in the business to then pay the expense. But then those things get lost. Yeah. So the Travelocity plane ticket that you bought to go to the national conference for your industry is somehow lost in some Travelocity bucket along with, the ticket to Orlando to go see Mickey. Yeah. And it just doesn't make it in. Or like I said, the big training programs because the money's gone. And especially if it's a monthly kind of fee, it may be on a credit card that you think you moved it over to the business, but you forgot the first 2 months, so it's still in a different place. Or it was something that you pay for, 3 times a year, and you got one of them, but you forgot the other 2. It's not a closed system. So those expenses are not being accounted for in that bucket. They're not hitting your tax return. You're not getting the deduction. The income's staying higher. Taxes are blowing up. I mean, that's the biggest, fastest way to eliminate that problem is you've got a business account and you need to use it. And you need to use it exclusively. It's not like sometimes. It's not like I forgot.
I've got a question for you. Uh-huh. For people that are new to this, and maybe they started a business and they don't have a lot of income right now. And they don't want to go out and get a brand new business card because they don't have kind of anything to show for it yet. Yep. Do you suggest people using a personal card and then just keeping that personal card for the business?
That's it. That's fine. So most people have more than one Visa or MasterCard anyway. So you take one of them, and there's this cool little invention called a Sharpie. Yeah, it's really neat. You write on one of them, B-I-Z, and you leave the other one pretty, like it's your personal one. And you only use that B-I-Z one for business. And you pay for it out of the business account. You only use it for business. The other thing is you can get a Visa or MasterCard logo debit card that hooks straight up to your business bank account that you can do most of your, if you have to go to Travelocity and buy a plane ticket, so you can't write a check or pay through PayPal or whatever, at least that way it's linked directly to that bank account. So to follow up on what you were saying, if you have, sometimes people will have their business account and their personal account. They've moved the money over to the personal account. And then they go, oh, no, I have to pay for something here. And they don't think they're allowed to put it back. Yes, it's your money. You're allowed. Put it back, think of it as a loan to the business. Put it back into the business account. and then pay that credit card bill or buy that new iPad or, pay the person that's running your Facebook ad campaign. Put the money back. Don't say, oh yeah, I'm just going to remember. We don't remember what we had for breakfast like 2 Tuesdays ago. You're not going to remember. You got to have the system.
Yeah, and that's an important point to make, I think, is that, in the offline versus online world, we very commonly, we don't think twice about like if we're putting money into our offline businesses is an investment. We write a check, it goes into the business bank account, we're investing into the business. When it comes to the online world, I don't know why, but for some reason it seems people think of it differently, but it can be really the same thing. If you need to pay for something, but your business isn't making any money yet, you can take money from your personal account and invest it into your business account, and then you pay for it in there. So I think that's a big point right there that, it's the same for both offline and online. If you need to do something in your business that costs money and you have to do it from your personal account, you would do it as an investment into the business, because then it keeps your taxes are going to show that you invested, $5,000 in your business this year, and that is a kind of a write-off, correct?
Well, the thing you spent the $5,000 on is the write-off. You moving the money around does not change the profit of the company. But if you needed to put $5,000 into your store because you needed to buy more inventory, a great deal came up for a chunk of inventory, but you've got to buy it at a volume above what you normally would. That purchase, that cost of goods sold for you in your storefront is an expense that is deductible. So yeah, if you're putting it in there, it's probably because you're paying an expense that's going to be deducted. So that commingling is a big thing. Now, kind of a subset of that would be, especially for people that are running around a lot, doing networking, they're in their car, they're traveling to seminars, they're traveling for coaching programs, they're traveling to meet clients in different parts of the country, they're going to do speaking engagements, they're on the road. It's so easy to pull a $20 bill out of your wallet to pay for something, and that $20 bill just, like, you might as well have thrown it out the window as far as your tax return is concerned, because there's not a record of that sucker anywhere. I mean, it just is gone. So being able to, just like I said, the commingling, you don't want to have it scattered in a different bank account or different credit cards. You also don't want it being cash. That $20 here and $40 there and $36 for this and coffee on the way and subway tokens and taxis, and oh my God, that stuff can add up to thousands of dollars a year.
Yep.
It really can if you're on the road a lot. And thousands of dollars a year in expenses is $1,000 a year anyway in vacation money. So you want to keep track of that cash stuff. You want to use that debit card whenever you can. Or a lot of times I'll tell people there are those incredibly annoying, like plastic coupon keepers that are like fluorescent orange and pink and like day glow yellow. Well, that's great because you won't lose it. But I say you stick one of them in whatever your briefcase, your backpack, your oversized purse, whatever it is. And when you're running around doing things for cash, somebody's handing you a receipt. I mean, even Uber can like freaking email you a receipt. Taxi cabs can print it on the spot if you pay for cash. So you just stick that in there because then at least you can record that when you get home. So the commingling thing is a really big one. The other place that people miss a lot of deductions is when it comes to auto. Auto is enormous. Nobody wants to keep a mileage log, and everybody drives their car more for business than they think they do. So you got to run to the bank. Oh, that was business. You have to go send something through the post office because it's too heavy and you need postage, or it's got to be certified return receipt. Well, that was business. You ran out of your favorite pink neon Post-it note and you have to go to Staples this minute. Oh my God, that's business. Business lunches, business networking events. All of those miles can really add up. And there's not even a way to track that. Even if you're like the perfect QuickBooks person, you can track mileage in QuickBooks. But there's not a way to track the ins and outs of cash. So there's a wonderful app called Mile IQ. I love this app. This app like saves people in audits. And if anybody puts a note into the Facebook page, I have a discount code that I can put in there. It is a paid app and it's fairly expensive. It's about $60 a year. That's a blip compared to what it will save you in taxes. But you install it on your smartphone. Everybody's got one, can't live without it. Super, super, super easy to use. Will give you downloadable reports. Great app to really capture all of your mileage. And while you're capturing your mileage outside of just our business miles, the app can also track medical miles that are deductible, charity miles that are deductible. So there are a lot of people that every weekend, you know, I've got a number of clients that they go volunteer at some kind of not-for-profit, at an animal shelter or at a rehab center or at a veterans kind of facility. And that mileage back and forth every week, 52 weeks a year, that all adds up. If you've got any kind of significant medical situation going on, which is, of course, never a good thing, there's a whole other side of things with medical deductions. But keeping track of those miles, and the app will do all of it. One app, all deductions.
That's pretty cool.
Yeah, that's great. The other thing is really looking at your actual expenses. It's probably good to, for some period of time, to do an analysis of your actual expenses versus just the mileage. If you're driving a Prius and you get great mileage, or you don't drive hardly at all because you really are just working in your house virtually, then you want to just use the mileage method. It's the easiest, and for a car that gets great gas mileage, you're still getting the discount even though you didn't put any gas in. But if you're driving an older vehicle, if you're driving a lease, if you've got work vehicles or delivery vehicles that are doing things, if you've got a ladder on the top and a Gatorade bottle on the back, you for sure want to be looking at, is actual expense better than the normal mileage adjustment? So that's another place that people lose big time. I mean, big time, super easy deductions by not doing that. Another thing is, if they don't have good numbers and they're not managing their cash flow well, people they just are kind of living with, well, there's money here and I got to go grocery shopping, or they're just a kind of a mess. They're not budgeting in saving for their own business's retirement plan for them. So they're not socking money away into a SEP or their single 401k or a simple IRA or whatever their tax deferred qualified retirement plan is. In the world of taxes, at the bottom of the first page of your 1040, there's this magic number called adjusted gross income. That number starts the dominoes for so many things in your tax return. You want that number to be really, really low. You want it to be as low as possible. If you're going to be subject to the Affordable Care Act, you know, additional taxes that come at higher income levels, they start hitting you at $250,000. If you don't want to be subject to your itemized deductions being phased out, child credit, child education credit, student loan interest, all of these credits that are available through the tax return can be phased out if that number is too high. If you can show some of your income over here into your SEP, into your simple IRA, into a tax-deferred qualified retirement plan, that's a deduction before that AGI number. It gets that number down. So not only are you doing what you ought to do for your future, but you're now leveraging getting that student loan interest deduction, not having your itemized deductions phased out, not being subject to net investment income tax on your investment earnings, possibly being able to take losses if you have a rental property and you would be allowed to have losses. If that number's over a certain level, those losses are put in a closet. That's a huge domino area. But if you don't have a handle on your bookkeeping and you're just kind of running off of, well, this is where my cash is, and you're not budgeting, you know, $1,000 a month goes into my SEP, $500 a month, whatever it is, you're not taking advantage of that deduction, and that it's a domino.
Huh.
Thought you were
I
going to
had
say
never
something.
thought, I didn't know about that. I mean, not that I'm a tax professional, but we do, go through the process every year with multiple businesses and talking through that stuff with our CPA, but I hadn't heard of that before. So I will definitely have to
Yeah.
have Tom and I look into that and talk to him about that next year for taxes for this year.
Yeah. The other thing is, if you've got a really good handle on your cash flow, you can then do some projections. So let's say I've been getting a lot of emails lately, and I'm setting up appointments now for October and November for the clients that I want to see, well, I still have enough time left before the magic December 31st. Once I cross that threshold, I can't go back and change history. Like, it has to happen before we hit that threshold. So I want people to come in so that we can do projections, not just till December 31st, but what is next year going to look like? So we can have discussions about, where's your business going to go next year? We may want to take advantage of, if we have a really high income this year, do we need to spend some money at the end of the year? Do we need to prepay for that big coaching program?
Mm-hmm.
Do you need to buy a new server? Do you want like bigger, fancier monitors because Tom can't work with just one? I saw him on the couch with only one. Crazy. That what do you need to invest? But if your taxes, if your income's really projected to go up and you're going to be making more money next year, I may say no. I don't want you to buy it till January 2nd. Because if we're going to be in a lower marginal tax bracket this year compared to next year, I'm going to get a bigger bang for that buck next year. We're not going to know that if we can't project our business. We can't project our business if we don't have any numbers to project. You kind of got to get a handle on where is it going, what's happening. But that can be a big thing. Moving a $10,000 expense from one year to the next, if you're going to be bumping up a tax bracket, and that's the next marginal number, I mean, even if you're only going from 25 to 28% tax bracket, that's a $10,000 expense. That's $3,000.
Yeah.
Vacation. So that timing and does it get you a better bang for the buck on your tax return, knowing which year to put it in? Then there are a couple little things I wanted to mention that don't necessarily equate directly to tax savings, like, the auto and travel and the retirement contributions and that, but they equate very consistently to the amount of money you have available and how are you wasting it. So I sometimes see clients, they come in at the end of the year, they bring me shoe boxes and bank statements, and I cringe. And I'll go down, I'm looking through the bank statement, service charge, service charge, service charge, service charge, bounce check charge, bounce check charge. They're not reconciling accounts. They're not covering their expenses, and they are wasting tons of money on credit card finance fees and bank service charges. Now, if they're not operating out of a business bank account and they're not doing their bookkeeping, lots of those bank charges aren't getting onto the tax return. They didn't reconcile the account. They didn't make the journal entry to deduct the bank service charge. Well, there just went a couple $1,000s. That is a direct tax thing. But more importantly, it's just money that you're shelling out, and you're ruining your credibility with your vendors. You're creating unnecessary work because now the credit card's been declined and you have to go back in and reset it up. And isn't there something more important for you to be doing with your time than that? So that bookkeeping stuff, that can really affect that. So let me talk about this for 1 minute. Most of us are basically selling our brains. I like to laugh with my clients that those are the clients I like best. I don't really work with much retail. I've only got a couple manufacturing clients, just a couple retail clients. I work with clients that sell their brains. It assumes they have one. That makes them much more interesting. It's all good. But if you're selling your brain, unless it's in a passive income product, in alignment with your time. If you're not tracking your time, you're not billing for it. I mean, it is amazing what a good time tracking system will do to increasing your invoices issued. If you're answering an email and you're a consultant in some way like I am, and you answer an email and it takes 5 or 10 minutes, okay, that's called good customer service, suck it up. If you're answering an email and you spend 20 minutes and you attach 3 links and a worksheet, that's called a mini consultation, bill for it. Because if you do 4 of them a day, you just worked for an hour for nothing. Well, how many hours do you want to work for free? We all work enough for free as entrepreneurs with the planning and the technology and the continuing education and licensing requirements and, you know, all the things that we do to make our business run. If you are delivering services and you are delivering the knowledge that you sell, it needs to hit a timesheet, so it hits an invoice, so it hits your bank account.
Yeah, that's a huge point to make right there. I hadn't even thought about that. I mean, I think about it, but I hadn't thought about tracking all of that separate time, because not only does it give you those billable invoices, but if you're just getting started offering services, that's a great way to see how much actual time you're spending on each client, because you need to know that to be able to both manage your time, and then also when it comes time to raise your prices for whatever services you're offering, you know, I know a lot of us feel guilty or, you know, have that fear of, oh, I'm raising my prices. When you look at what you're actually doing and how much time you're actually spending on it, I'm sure a lot of us would see that we need to raise our prices just based on how much time we're putting into each of those clients. So that's a great point.
Yeah, I mean, I have some clients when I sat down and we've actually torn this apart, like I've had them do kind of like the diet, the food log, we're going to do a time log. And we start looking at it and I can point out to them that they would make more money working for minimum wage at McDonald's than they're making on some of their clients, which leads us into, you need to fire clients. Like, you need to know what your profitability is by the client. You know, I track my numbers. I can tell you on this client, I make an average of blankety blank over the course of a year, effective rate per hours. And I take into consideration staff costs if staff works on the client, but knowing what client do I have to work on because they're just at that level or I have to do it. I can't hand it off to any staff. I can't bill my normal fee because it's all me. I'm not leveraging me at all with staff. Or for some people that don't, you know, people in the Facebook group that don't have staff, but they may have a VA. That is staff. You are leveraging your time by utilizing a VA or an assistant or your mother-in-law, you know, or whatever. But if you have to be doing it, you need to know, what is this taking out of you? And, you know, firing clients in the beginning, it's really hard. It gets much easier. It just takes practice. When you start realizing, it's kind of like cleaning out your closet. It's hard to get started. But then when you love your closet because you can find everything, for my husband, that would be his workroom. You know, oh my God, he can now find that damn wrench he was looking for because he got it all cleaned out. It's so worth purging the nonsense and purging those 20% of your clients that are driving you nuts. Like, get them out of your space. And sometimes you look at the name on caller ID and you're like, oh my God, help me now. And you know you need to fire that one. But sometimes you just know you need to make space and you start looking at what's your effective rate per hour on your clients. And it's a great way to kind of separate who do I want to keep, that I just need to work on my fees, who can I upsell into other services, who can I leverage to other professionals so that we have a captive, I call it a sticky client. You know, you get the client sticky. If they're working with me and they work with my favorite attorney and they work with my favorite financial planner, it's a sticky client. For them to separate out, they're going to have to get rid of a lot of their support center. But that tracking time is a huge thing. If you're in business to make money. And if you sell your brain, you make it by selling your brain. and you need to be keeping track of that, get that income in, then you'll have money to pay your taxes.
Yeah.
Another record keeping mistake that comes up, and I just saw this one not that long ago, working on 2016 return for a client. They were going back and recreating 2016 in the middle of 2017. And they were going through their invoices they issued in December, and they counted them in their 2016 income. Now, they came in, I did their taxes, and then I was working on their 2017 projection. They got paid in January.
Mm-hmm.
They counted the income again because they're not using QuickBooks. They're not issuing an invoice and receiving the payment. They're just kind of doing it like, here's all the invoices I issued. Then they got smarter. They started understanding cash versus accrual. They got paid. They counted it again.
Oh, no.
Let's not double count our income. Let's not pay taxes twice.
Mm-hmm.
You know, it's bad enough that we pay federal, state, sometimes local or city, and self-employment all on the same dollar. Don't do it again. Please. But not having a good accounting system that's handled consistently year to year and recreating things way after the fact, you can't remember. You know, we're back to that you can't remember comment. So it becomes a problem. You had said something about, like, if we have to put money back into our business.
Mm-hmm.
So let's say for you guys, you got the opportunity to buy a huge block of inventory for the store, and you're like, oh my God, this is a really big block. You know, this is a $15,000 block, and we do not have $15,000, just like the Tooth Fairy didn't leave it. We don't have it. So we're going to tap the home equity loan.
Mm-hmm.
That home equity interest is deductible on your personal tax return, but it's also now business interest.
Okay.
Because it's for a business purpose. If you move that over to your business return, your Schedule C, if you're a single member LLC or a sole proprietor, you're now saving yourself self-employment taxes.
Ah, okay.
But you got to know to move the interest.
Mm.
You have to understand that's a deductible expense. So that business debt, for some people, business debt can be fairly significant in the first year. And they're financing it on credit cards, which have really high interest, or a home equity loan is always a better plan. It's at least deductible over there, but you could allocate some of it to your Schedule C.
And this is why we suggest meeting with a tax strategist at least once a year, because this is the kind of stuff that you don't know that you don't know.
Right.
You know, you can only research so much on the internet. You can only read so many helpful guides. You can't apply it if you aren't in that arena, if you haven't been, you know, educated in all of that stuff. So, right. You know, we meet with our CPA at least once a year, sometimes twice if necessary, because there's so many moving parts. When you have a business and then you've got all the personal stuff, and then if you have a second business, or, you know, even if you're just kind of selling products versus services, so many different moving parts. I wouldn't have even thought about that because, you know, why would I? I'd just be like, oh, we're investing in the business. I wouldn't think about the moving the taxes over on top of that. So this is why it's important to meet with a tax strategist. This is why it's important to have a bookkeeping system, because they would catch that in your, when you give them a good one, would catch that when you give them, you know, your QuickBooks report or your file. They would say, hey, is this from your home equity line? Did you invest in your business from your home equity? Yes. Okay, now we're gonna do what we need to do on the tax end of things. Like, you don't know all of these things, and I see for a lot of people that because they don't see the huge impact right away. So it's tough to think that it's something that you need to do, like it's urgent. But I've seen a lot of people lose money in some way because they didn't do it, and then they regret that. So this is more of a being proactive instead of reactive thing, and that is speaking to a tax professional at some point. I understand a lot of people don't want to do that early on because, you know, they don't think, oh, I'm not making a lot of money, so I don't need to hire a tax professional. It's still
But
important.
you want to take advantage of those deductions. And again, I can't stress enough, meeting with somebody in October, November, December. I'm smart in October, November, December. I'm really dumb in March. I'm tired. I'm frustrated. I haven't had a day off in 90 days. I got a pile of files up to the ceiling. That is not the time I'm going to be able to sit down and really think clearly and help you analyze it. And I can't go back to pre-December 31st and change history.
Mm-hmm.
So if you want to get the most out of your accountant, you don't depend on that February, March meeting.
No.
You get to them when they have time to get to know you. You want them invested in you personally. And, just to put some numbers to some of these, let's say you just drove your car 5,000 miles. That's a $2,500 tax write-off that Mile IQ could help you catch. Let's say that you just put $6,000, $500 a month into a SEP or an IRA or your 401k. That's $6,000 a year. For most people, that's going to be at least another $2,000 tax savings, plus whatever the trickle downs are because of your AGI getting affected. If you've got your money in line, you're going to have no bank service charges. That, again, can be thousands of dollars of real cash flow and at least hundreds of dollars of tax savings. So this stuff trickles down, the travel expenses that you're not catching because they're either cash or they're over on that other credit card or that other bank account. I can't tell you how easy it is to get those things added up.
Mm-hmm.
And then I just wanted to say that when you mentioned that I'm a certified tax master, so most accountants will say, sure, I do tax planning. No, they don't. I define a tax return as little numbers in little boxes. I'll keep it clean about stuff that already happened, right?
I forgot to do the disclaimer at the beginning.
I've been really good there.
There might be a random F-bomb thrown about, but she has been really good so far.
I've been really good, see? But tax planning is proactive. Most CPAs are trained to be reactive. They look at history. All they're doing is looking in the rearview mirror, putting the right little numbers in the right little boxes. After the fact, we can only move them around just so much. Real tax planning takes advantage of the IRS code. Are you utilizing everything you can use from the code? Are you in the right business entity? Mm-hmm. Do you have a MERP set up for your family expenses? How are you dealing with your personal health insurance? There are all these code things that we can do. Then there's shifting. Shifting is deferring that income in your retirement plan, moving it into a different, that's timing, moving it into a different tax period. There may be shifting. Can you move income into a lower tax bracket via another person around you? Can you move that over to a kid's tax return? There are a lot of people that you come in contact with whose kids can set up Facebook stuff, but the owner of the business can't. That 15-year-old kid may be able to do something. You may be able to pay them. Mm-hmm. They have to file their own tax return, but a whole bunch of that income is taxed at zero, not at your rate. It's still a legitimate business expense. Use shifting. And then how are you using product through your financial planners? How are you saving through different tools that they have? Nobody that's ever played the game of Monopoly has won unless they bought houses and hotels. You have to have product. You have to use financial products to win the financial game.
That sounds
so when I do tax planning for people, we look at timing, shifting, code, and product to go, where can we find avenues that aren't just little numbers and little boxes about stuff that already happened. And after the fact, there's just only so much we can do, especially if we don't have great bookkeeping. So hopefully that gave you a whole bunch of ideas and some things you've never heard of.
Lots of ideas.
For anybody that watches, for some specific questions, they can take their Tax Pro and be like, well, tell me about this, or tell me about that, or how do I know if I'm in the right entity? And I took money off my home equity line. And what can I do with that interest that's better? How should I set up my retirement savings? Can I hire my kids? And what the hell is a MERP? So there's more avenues for saving money, permanently saving it, or for smartly deferring it than most people are aware of, because they don't ask the questions. They don't have the conversation at a time of year when their accountant can be really present with them and is not distracted and can get emotionally and mentally invested in the client's whole picture, not just the business. Yeah. It's part of your whole life, and your whole life shows up on your tax return.
Yes. I love it. So much good stuff. I know that you could probably talk for hours about tax stuff, because Tom is the same way with business stuff. We could just keep going.
Right.
But I did want to get to the one question that we had ahead of time, which we kind of chatted a little bit about before the live, which was someone wanted to know your thoughts on business owners using profit first.
So profit first, I haven't worked my way through all the tools yet. I've heard about it a lot. Some people that I really respect are huge proponents of it. I think profit first is probably a great system if you use it. We're back to rule number 1, don't commingle your funds. And as we talked before the live went on, I think that there's a challenge for most people just to separate the kitchen from the business. And now we want you to have 5 buckets over here. Mm-hmm. If you get the system set up and it becomes a true system, it will take care of itself. But committing to do it right, which is absolutely necessary to make it work, you can't do it part way some of the time. You're either doing it or you're not doing it. Mm-hmm. So I love the idea of being able to really know where your money is all the time, of being able to set things aside, of making money in your business instead of just plowing it back in. Like, that's a hobby, not a business. And what are you supposed to be eating? Right? You got to pull money out to live. And if your spouse is supporting you right now, at some point, they're going to get tired of that. So if you can, no matter how small the profit is, it really helps the marital, that family entrepreneur life thing. Mm-hmm. It really helps the marital relationship. If the person with a new business can show that, yeah, it's not a lot now, but next quarter it's going up by another 2%. The quarter after that, it's going up. You can show trend. Yeah. So I think to the extent that it helps define a system for that, and it opens up the awareness a tremendous amount, that's invaluable. So if it's something that somebody's attracted to, I think it's great. I think you need to do exactly what he tells you to do. You can tweak it for your own personal things, but start out with, this is the thing that works. You can't make meatloaf with no meat. You can't tweak the recipe for meatloaf with no meat. You got to start with the recipe. Then you can decide if you want to put carrots in your meatloaf or not. Start with what he says. Do it like he says. Follow it religiously for at least 90 days. And then determine if you want to tweak it for you. That would be my gut instinct based on what I know of the program.
I have to just say, I love your analogies. You had a couple good ones before we started too. I should have wrote them down. So while we're waiting, if anyone's watching, if you have any questions for us, and for Christi, obviously, especially, please go ahead and post them up. But while we're waiting for anyone to post any questions, Christi, I'd love to know, from a personal standpoint, being an entrepreneur with a spouse, and you kind of both have your own thing going, what has been one of your biggest lessons, or what's your biggest piece of advice for our family entrepreneur members about this entrepreneurial journey?
Oh my gosh. Well, I have my own practice and my husband has his own practice, and then we have a partnership. And for us, the thing that helps us the most in our practices is my money and my practice are mine. His money and his practice are his. Our kitchen account is another thing. So I run my business. I have to contribute to our kitchen account, our set amount to cover our household expenses. But I'm a big believer in coaching and coaching programs and support and getting the tools that I know I need to take me to the next level. My husband, not so much. So he would never invest 5 digits in coaching like I would. So us having a very clear distinction with the understanding this is my obligation to our home has eliminated like all fights. There are none, because I'm wholly and independently responsible for me, my personal expenses, and my business. So that separation, I think, is huge. I also think that as anybody who's, especially in their first 1 to 5 years, I was going to say 3 to 5, but say 1 to 5 years of being in business for themselves, it is such a personal growth journey. You learn what you're really afraid of. You learn what excuses you have. You learn what you run away from. You learn what you need to be effective and efficient. You learn what really matters to you and what just drives you up a wall. And I think paying attention to that spills over into all the other areas of your life, and it gives you a richer life. It turns on the 3D. It turns on the surround sound in your life, because you're not just showing up and going through the motions like so many people do at a job. Even if you're really invested in your job, at the end of the day, you're not directly related to it like you are in your own business. And being able to show up that way in your own business teaches you, when you're with your kids, be with your kid. When you're with your spouse, and you must run into this all the time, my husband and I do, this is a no business dinner.
Yes.
Or, we're doing business for the first 15 minutes, and then this is a no business zone. Like being able to set those lines. Right now, this is me time. For people for mothers, oh my God, they need to carve out me time. Mm-hmm. You need to carve out your business time, your kid time, your spouse time. Being able to set healthy boundaries, probably the greatest lesson you learn from being in business for yourself. Now that I kind of chewed through that, sorry for the rambling. That thing about being able to set really healthy boundaries. This is what I charge. This is when my appointments are available. No, I don't want to work with you anymore. We have to bring this meeting to a close. This is how I'm spending my money. All of those are healthy boundaries that affect every area of your life. But you come face to face with them in a real quantifiable way when you have your own business.
Yes. I love that. I love that. Boundaries are so important. And I think they're constantly changing as well as we grow, as we go through and have those different experiences, as we get closer and more clear on what our why is, and as our why changes. I've definitely set some different boundaries this year. Tom and I have set some different boundaries this year. One of those being he can't coach me. We figured that one out finally. But yeah, I think that's so important to kind of think about all of those different aspects of the boundaries, not just the business boundaries, but also the home life boundaries, the marriage boundaries, the parent boundaries, and using all of those and having all of those. I love your analogy about like turning on the 3D and the sound, having that surround sound. And it just does. It just makes your life and your business and doing everything all together so much more fulfilling. So I love that. I love that piece of advice and that lesson. Christi, before I let you go, where can people find you? Website, social media? Let us know where they can get in touch with you.
Yeah, so I have website, ChristiBenderCPA.com. That's original, but it gets people to me. Needs a facelift, but it's got a lot of information on there about kind of my attitude. I have a business Facebook page that gets posted to at least 4 or 5 times a week with helpful tips, starting to do there's sort of stock video that explain different things that people need to know about. If anybody puts in your Facebook group a little link, I have a PDF that I can forward them, or if they PM me with an email address, I need an email address, I can forward them a document that has 10 different kind of tax saving tips that may be helpful.
Yeah, I like that.
The best place is Facebook and my website. I think some stuff goes on to LinkedIn, but I wouldn't guarantee it. I don't know. Not my realm of knowledge.
All right. So we will post those links up to Christi's website and her Facebook page. And then if you're someone who's comfortable sharing your email and you want Christi's document on the 10 tips for taxes, go ahead and share it. If you aren't comfortable sharing your email on the page, go ahead and send Christi a private message and let her know, yay, hey, that's me. I want your tax saving tips.
Right.
Christi,
right.
Thank you. Thank you so much for coming on and being my first official guest expert. You started it off with a bang. And if anyone's watching the replay, please feel free to, pop a question in as you're watching and tag Christi or I, and, we'll make sure that we pop back over and get that answered for you.
Yeah, if I get tagged in the Facebook page, I love being able to share advice and resources where I can. So if people have questions, I'm more than willing to do what I can, without overrunning things. But if they get in and they tag me in it, I'll make sure that I respond.
Awesome. Yay. So exciting. Thank you. Thank you, Christi. I'm going to let you go and get back to work. And everyone, thank you for watching with us this week.
That's it. Thank you.
Bye.
Bye.